Aswath, welcome to the One Road Research Podcast. It was great to see you in Vietnam. I think you remember our brief little conversations that we had when I was in attendance there, and I found a lot of the things that you had to say very interesting, and I wanted to share a few of my perspectives as well, and I think there's so many things that we can start to cover with. It's nice to finally catch up with you again.
I'm glad to be here.
So let's talk about some current events. There's a lot going on in terms of emerging markets. I think I'd like to start off with one question that I didn't get a chance to ask last time, particularly since currencies, as far as emerging markets, have declined quite a bit.
Right.
Is that ultimately component that, say, for example, a U.S. dollar denominated investor should be taking into consideration as far as even looking at valuation or even price of a particular asset that's domiciled in emerging markets? Ultimately, the first quote-unquote trade is the currency trade, and then going into the underlying asset or company that one might have an interest in. Do you take that into account as far as, say, price or valuation assessments?
Not even for a second. And here's why. Unless you're a currency forecaster, don't go there. All it can do is paralyze you. So the fact is, you have no idea what the Indonesian rupee is going to do. You know what it's already done. So ex post, it's going to do good things or bad things. Let's face it, for a decade, emerging market currencies helped you out. They went up when they should have been going down. Currency, high inflation appreciated. So you actually made more returns on your emerging market investments than you should have. Now they're going. So what one hand gives, the other hand takes away. And since you can't forecast them, just let it go.
Right. What about when that is happening in confluence with, say, for example, the equity markets also declining precipitously as well, which is what we're seeing. In the instance of, let's take China, for example, we've seen a decline in the overall currency, the renminbi, but then you've also seen the underlying benchmark indices there also decline as well. Now, remember, you're coming in from a U.S. dollar international investor perspective. I know obviously you isolated and you said no.
What the U.S. and the dollar have anymore. I'm an investor. I look at my portfolio at the end of every year. More than half my investments are outside the U.S. I look at the returns in dollar terms. It is true. But I'm not sitting there saying, what is my U.S. investment? So after all, what's my U.S. investment? If it's in Coca-Cola, it's actually as much an emerging market investment as investing in MBEV. So I think that as an investor who might look at my returns in U.S. dollar terms, there is a message in equity markets, in emerging markets going down, which is that the market, for better or worse, perceives more risk in these markets than it used to. That's something you have to factor into your valuation. That's what I try to do with my equity risk premiums being higher for some markets than others. So I think that is going to affect the value that you perceive in the company. But remember, the price is also adjusted. So it doesn't necessarily mean you're going to avoid emerging markets, because if the price has gone down too much, this might be the time to buy.
Yeah, so on that subject, well, actually, there's a few things I wanted to say. So as we were speaking when we were in Vietnam, you highlighted some interesting companies, but during the duration of the last, say, decade or so, you've seen, due to some kind of Asian currency war, you have seen effectively a lot of these currencies decline by upwards to 50%. So in that duration, say you go from U.S. dollar into the Vietnamese asset, holding it in VND, even adjusting it for your equity risk premiums, but then ultimately you got to go back to U.S. dollar if you want, let's say, some liquidity if you sell out of the position. That does have an effect in your overall total return to some capacity, doesn't it?
Oh, yes. Not just some effect. It has a big effect. It has a big effect in both directions, right? So if I'm in Brazil from 2004 through 2014, I made whatever money I made on Brazilian stocks, but I also got about a 50% appreciation coming from the real strengthening over that decade. As investors, we tend to, when those things happen, we act like it's our doing. We act like, we were the ones who went out and picked these kind of countries because the currency would appreciate. So we take it as our picking that gave us those returns. The minute currencies go down, guess what we do? We start blaming others. We say, look, It's a currency sport. I'm not doing well. Hey, you know what? Over the long term, currency is one of those things that gives and takes away. I'm never going to complain about a currency going down and making my dollar returns negative. Because I remember in the long term that has happened as much on the positive side as it has on the negative side. I mean, all you can do as an investor when you invest is you can bring in the risk through the risk premium. You can bring in the currency by making sure that you are building an inflation expectation into your expected return. And then you move on. Beyond that, there's not much you can do.
So what do you think about everything that's been going on as of late, particularly due to, like, obviously we've seen a lot of influence due to the macro components, particularly with the trade war dialect. Does that make things attractive to you now with the decline that you've seen in emerging markets the world over?
Well, I'll be quite honest. I will never buy a Chinese stock. I don't think you actually own equity in a Chinese company, to be quite honest. You're just a supplier of capital. It's sticks in the crawl, and companies want to have their cake and eat it too. They want to come for your capital. They say, give me your money to buy the shares, and then they treat you like dirt. I mean, Chinese companies are treated are dictatorships. I mean, and that goes from the very top, the very biggest companies. I mean, whatever you might think about Jack Ma, he's a benevolent dictator. There's no democracy there. There's no sense that you as a stockholder have a say. So China is off the board for me simply for that reason. I do not feel like I mean, remember what Warren Buffett once described as his stock ownership. It's you feel like you're part owner of the company. I never feel like I'm part owner of the company with the Chinese company. Are there other markets where I'd be interested? Absolutely. At the right price, I'd buy in any market. So at this point in time, what you're looking for are looking across emerging markets, and I include Turkey in that. I'm looking for companies that have been punished indiscriminately just because they've been in that market. Because let's face it, when investors panic, they sell everything. They sell the good companies, the bad companies, the companies they should be selling, and the companies they should not be. So going through the wreckage is where you're going to find some of your best bargains.
Right. That statement that you make about China is very interesting. Like, some of the very characteristics that you highlight are equally as applicable to many countries within the emerging market. Like, hypothetically, one could argue from a sheer corporate transparency and corporate compliance standpoint, there would be very few markets that would fit this
You don't need markets. You need individual companies. Remember that markets provide a floor for what you can reveal and how much power you can get. You as a company can go well beyond that. I'll give you the example. I mean, if you go to India, the technology companies in India have been much more open to shareholders speaking up than the old-time family group companies. So it's not a question of our entire markets. The problem with China is it is very much of a top-down market. It's a market where so much of the economy is still, it's still driven by, I mean, look at a company the size of Tencent, how easily the Chinese government is able to bring it down 3 pegs. That is, I think, that is the Chinese system. It is a system that's worked very well for them in the last 15, 20 years in terms of developing economic growth. But as an equity investor in this system, you're exposed. You're incredibly exposed. And that, I think, makes the Chinese market much riskier than many other emerging markets to me.
What's so fascinating is that we actually have this model. We call it Asian capital development. And what's so interesting about your statements is that a lot of Asia actually is structurally shaped in the manner in which China is. For example, we were just in Vietnam. I could argue with you that Vietnam is almost identical. The only difference is that it's a little bit smaller. It very much is a top-down economy. When a metrics that we could use is the size of, say, state companies or the government relative to GDP. Now, what's so fascinating is that one could even make a case that this very model was seen right after World War II in places like Japan, South Korea, obviously North Korea, China, Vietnam. A lot of these countries, I think perhaps there's some Confucian component to this.
I agree with you, but take a look at Japan. It's the only model out there that's been around for long enough that you've seen it go through. The test of a model is not how well it does in good times. Every model is not good. It's how it does in bad times. And I think
Right.
Japan is a perfect illustration of the downside of this model, which
Yes.
is 50 years it worked incredibly well. You know what these
Right.
models do very well? They're very good at dealing with individual companies screwing up or a
Hmm.
particular, they're very bad at dealing with systemic problems. I mean, take the
Yeah.
example of chaebols in Korea, right? For a
Yeah.
long time, they looked incredibly good. They brought South Korea from these ashes to this almost developed market status. Then you get to the
Hmm.
1990s and you realize they all borrow way too much money. But nobody
Right.
can see it as a problem because it's so, I mean, it's a system that's so inbred in a way, which is
Yeah.
everybody kind of agrees with everybody else. It's an elitist system. That's basically it. It's a system run by relatively few people who essentially have all agreed that this is the way to run companies. And as long as things go well, these systems work incredibly well. And then
Right.
when you have a systemic problem, they have a really difficult time dealing with systemic problems because their egos get in the way. The one
Right.
thing you can say about market-based systems is market-based systems are messy. I mean, let's face it, you look at the US system, you have hostile takeovers, you have proxy fights. There's a lot of waste in the system, but
Hmm.
markets have no egos. What I mean by that is markets make a mistake. The price will adjust 95% in the course of the day. When
Right.
elitist systems make mistakes, their tendency is to cover up and hope the mistake goes away. And for
Right.
25 years, the Japanese economy has suffered because Japanese banks in the 1990s would not admit that they made bad real estate loans. They've in
Hmm.
a sense paid the price for it. So there's an upside to the Asian system. The upside is you have a more cohesive system, a less wasteful system, a more focused system, and that delivers growth. The downside is, God help you, there are weaknesses in the system because this is a system that's designed when there's a weakness to cover up the weakness and make it look like it's not there. And even if you're looking at the most successful purveyor of the system right now, which is China, the
Right.
question that a lot of people have is what's below that glittering surface, those infrastructure investments, that amazing growth story? Are there things under there? And we're going to find out. And we're going to
Yeah.
find out when growth in China drops below 4 or 5%. Because that's when these systems start to come under stress and the weaknesses of the system are exposed. So for those Asian countries that have modeled themselves after China, they have some good points, but there's also this fatal weakness you have to think about in the long term of systemic problems that don't get dealt with quickly.
Yeah, I think our perspective to it is like we're absolutely aware about the structural
And
inefficiency.
being aware is not going to help you.
Exactly,
Aware.
exactly.
It's really, because when times are good, you can be aware, but it's human nature. You can be
Sure.
aware that you're doing something stupid, but guess what? If it's working well, you're not going to stop doing it. So being aware, I mean, so in the mid 90s, I was actually in Seoul doing my session to probably 100 CFOs in the room. I went
Right,
through the capital structures and one after every company in that room was over levered. All the
right,
CFOs agreed that they were carrying way too much debt given their operating cash flows.
sure.
But their defense was everybody's doing it. How can I be the oddball out? And furthermore, the system will take care of us, which is if things go bad, there's a backup. There's a backstop. The government will come in and act as the lender of last resort. So these
Right.
systems, you can be aware of their weaknesses, but that doesn't make the weaknesses go away.
No, it doesn't. But I think as what I mean by that is one has to be cognizant if one wants to navigate within these kind of systems. Obviously, when you do have the extent in which the state has over this kind of economy, you must be cognizant of other factors besides the underlying fundamentals, which the macro. I think that's what we're referring to. The understanding the structure of these economies, how growth has been predicated. And actually, that's very interesting that you brought up the subject of debt, which a lot of the media frowns upon, and I get that perception. But I think due to the structure in which central banks have played a massive role within the economy, I think it's almost undeniable to not attribute debt to growth, the growth that we're seeing as far as, say, global GDP. Now, obviously, you can get into a situation where you're over-leveraged, but
Yeah.
I don't know how you can generate growth then without a system based on central banks,
That's not
which is the point of singularity, and still be able to generate that GDP growth.
That's not true. All you need is capital. Capital can come from debt or equity. The reason Asian countries have refused to issue equity is they have a control issue.
Sure.
Countries don't want to issue equity because they're worried about the consequences of giving up control. The notion that you can't grow without debt is just a made-up story. I mean, there are economies that have grown with equity and have grown primarily with equity. You don't need. I mean, think of yourself. Think of a young country the same way you have a young company. A young company needs capital to grow. A young country needs capital to grow.
Sure.
The best source of capital for a young company is equity, not debt. Because if you borrow money, you're creating commitments you cannot meet as a young company. The same thing holds for a young growing country. It makes far more sense for Vietnam to grow with equity as its primary base for capital rather than debt. So I think that it's a mistake because what it does is it creates far more, it creates a whipsaw effect, which is you do grow faster when times are good, but guess what? You drop faster when times are bad. On average, across the long term, I don't think you grow any faster with that. You just create much more ups and downs in your movement across time. So this notion that without the debt you could not grow as fast is, I think, false. I think if you're willing to give up control of companies, and many managers are not willing to do, many families are not, you can accomplish the same growth with a much more healthy way of raising capital, which would be equity.
I think what I mean by that is the relationship between the government and the central bank. Effectively, currency, it becomes an IOU. So when I'm referring to debt, I mean the fact that even if you have a central banking system in which you issue out currencies, which are IOUs, then ultimately that's the first iteration of debt into the economy. And then in reference to what you just indicated about growth and in countries, command economies like Vietnam or like China, obviously equity is a very sensitive issue because obviously these states are predicated on, wealth redistribution, and for individuals to own a large percentage of quote unquote state-owned enterprises, that would be almost like a philosophical contradiction. Therefore, that's why debts through commercial banks have been a major source of the capital through the form of coming from the central bank, the directive of the central bank, which issues out currencies that are the IOUs that then inflate the balance sheets of these companies from a perspective of liabilities. So that's what I'm referring to in this instance. Again, I'm not saying that I don't agree with all of this. I'm just saying that these are just the natural features of these types of economies.
Yeah, what I'm pointing out is they're not natural. They are chosen features given the places these countries evolved from. And the one thing I would add is it is true that there is this issue of national companies being owned by stockholders.
Yeah.
That is, it's nice fiction to believe that somehow by not issuing equity, you're not selling out to stockholders. The reality is taxpayers or the citizens of the country really don't own these companies. They're owned by the hierarchy that runs the governments. So it's very self-serving on the part of these governments to say, I'll use the example of India because I'm most familiar with this because in the Indian government has historically refused to allow foreign investors to invest in infrastructure companies, in financial service companies. The argument was you can't let a foreigner control these vital sectors. And yes, it's true. They've kept the foreigners out. These sectors are horribly underserved. In fact, the people they claim that they're serving, which are the poorest people, end up being the ones hurt the most by the restrictions put on these sectors because there is no power. There are no infrastructure investments. So government basically is essentially used ideology as a rationale for delivering really bad services. So I don't disagree with you about the history of these countries driving the choices they made. And the Asian growth story is an incredibly powerful one because in the last 50 years, you've probably seen more growth in Asia, or at least in parts of Asia, than you've probably seen in hundreds of years prior to that. So there is that incredible growth story. But I think that anytime you have this much growth in this shorter time period, you're going to have weaknesses kind of under the surface, and you want to build a system that is a robust system, a system that can bounce back.
Mm.
Because there, I guarantee you, in the next decade, there is going to, and it could already be starting, an adjustment to the growth. Because when you go 10 steps forward, and not 5 steps forward, 2 steps back, 5 steps forward, you keep going forward, forward. That's not natural. That's not the way economies historically have grown. There's a reason you have recessions in normal economies. Recessions are not bad things. They're just the economy kind of readjusting itself, recalibrating so it can grow again. So what you have to hope for is the recoveries provide more upside than the recessions take away. And over time, you get that growth. But if you have an economy where you don't have recessions, you have growth, you want to deliver 8% growth every year, and that becomes your calling card. We've had 8% growth for the last 15 years. That's not natural. And that's the danger of trying to go for growth all the time, is you're not giving the economy a chance to adjust make the adjustments it needs to make to kind of move forward.
Yeah, definitely. Yeah, there's so much to discuss about that, and I'd love to touch on that subject maybe sometime down the line as well. I think there's a lot of sociological implications to your statements as well, so we'll cover that maybe on another basis. I'd like to jump to another interesting subject. I had a chance to hear one of your conversations about the inability to try to provide a valuation for something such as gold prices. And I'm actually going to be doing a conference on mining I think next week, actually. So I was just looking into this, and I wanted to get your take on the relationship between commodity prices, particularly like gold, one that you might not be able to create some kind of intrinsic value for, and then its relationship to mining companies. And I think that there's an amazing feedback loop that's happening within the aggregate financials of these companies that are working towards creating supply in the market. Because ultimately, like you said, is that maybe gold can strictly be understood based on supply and demand factors. So what do you think, if one was like an astute mining analyst, particularly for gold, how would one be able to use the numbers, I guess, in this case, to identify the narrative between gold prices or spot prices and then its relationship with ultimately the miners, which are creating the supply in the market, relative to the demand, which could be indicated by price, or maybe if I was to look into futures between, like, say, for example, net longs, net shorts, and stuff like that. So what are your thoughts on that? I'm actually trying to work on this. I'm trying to put it together a very nice model that explains the leading and lagging relationship between the supply and demand elements. So I love to get your take on it too.
With most commodities, it's the supply of the commodity versus the demand that sets the price. Gold is unique. It's not really a commodity. It's part collectible, part currency.
Sure.
And the reason I say that is, if you think about how much gold is in the world, I think with the 8 trillion, I don't know, what some absurdly large amount. I mean, at one point in time, a third of all the wealth in India was held in the form of gold. And that's still true, a lot of gold. So the point I'm making is that unlike other commodities, the price of gold is not set by the current production of gold. It's actually set by how much gold that is underground comes to the surface at a certain price. Let me give you an example. If gold prices double tomorrow, well, you're saying people are going to go produce more gold? They don't even have to produce more gold. There's so much gold that's under, it's going to come to the surface. So gold, unlike other commodities, is a very strange commodity to price. You can't price it based on how much gold is being produced and how much gold is demanded, because you have all this surface gold coming, under the surface gold coming to the surface at a certain price. So it remains one of those mysteries. How do you price gold? And the reality is you've got to think of it as a currency. The reason how people are willing to pay a higher price for gold historically is because they don't trust paper currencies. It's been a very, very strong relationship. What's messed up that relationship in the last decade is the arrival of the cryptocurrencies. Because they compete for the same space, right? If you think about even the terminology of Bitcoin, I mean, where's the mining when you're sitting in front of a computer trying to check a mathematical algorithm? But Satoshi Nakamoto clearly was designing gold for the millennials, which is what I call Bitcoin, saying, hey, here's something you can hold if you're paranoid and you don't trust anybody and you don't want to hold paper currencies. And that's what's made gold prices so much more difficult to deal. In the old days, if it jumped up around the world, you had a currency problem, like you do, right? In emerging market currencies, you could almost guarantee gold was going to go up. Now it's not. That relationship seems to have broken down because the cryptos seem to be sucking up some of the oxygen out of the air. So I think if I were looking at a mining company, that would be my concern, is gold prices for the first time in millennia have this competitor out there, which is not another metal. It's not platinum. It's not silver. It's this digital currency. And that is more dangerous because unlike those traditional competitors, digital currencies have no limit. You could potentially suck up all those people who buy gold into a digital currency if you could make people buy into that as being the digital currency for the long term. So I think that's what in the near term would concern me if I were a gold miner, is that gold price effect. That said, no, you can still look at, I mean, if you're looking at gold, don't look at demand and demand. Look at the amount of gold that is being brought into the market because of what the price is. And many emerging markets, I would not be surprised if people went back to their old way saying, hey, I trusted the rupee, I put all my money in rupees. Look, they demonetized first, now I'm down 20%, the currency's valued. Anytime people start to lose faith, they're going to look elsewhere, and gold, given its history, is going to be one of those things that people look at.
So besides gold, perhaps that was maybe not the best example because of your view of gold.
Oil is a classic demand.
Yeah, let's talk about oil in this case. I'm more interested in that relationship between the company's financials and its profitability, obviously working towards introducing new supply to try to make the market more efficient and therefore bring a decline in the price of oil. I think that's one thing that I'm fiddling with, which is basically margins, profitability ratios, and how that is an indication towards market inefficiency or market efficiency based on supply and demand elements, right? If commodity price is very high and my cost of extraction is relatively low, I'm going to be economically incentivized to extract as much as possible to sustain that level of margin until the underlying commodity starts to adjust and go lower and ultimately affect my margins. That's the kind of relationship that I've been thinking about and thinking about how to construct a nice model to that.
But remember, this is not like any other product. Right? With any other product, if the price rises a lot and the cost is low, you're going to produce more of the product because you want to make the maximum profits.
Definitely.
Finite resource, right? So if you're ExxonMobil, you know how much you have in reserves under the ground. Even if gold prices rise to $250 a barrel, you're not going to be bringing out huge proportions of those reserves today because then you run out of oil. So in a sense, you got to do that balancing act. You want to increase your production when prices are high and reduce production when prices are low, but you're constrained by the fact, A, that you have only a certain amount of reserves, and B, that the physical facilities you have don't allow you to dramatically expand it. I mean, if you look at a rig, I mean, it takes a couple of years to actually put a new rig in. So if you look at the existing facilities, you might be able to increase your production 15% or drop it 15%, but you can't double your production. It's just not feasible, physically feasible. So with those constraints, historically, oil companies have been pretty restrained about not overreacting in either direction to both higher oil prices and lower oil prices. The entry of shale oil, I think, has changed the game substantially. If you read yesterday, the U.S., I think, has become the largest oil producer in the world. It's now producing more oil than Saudi Arabia. Sure. And shale oil, that's basically converted the U.S. from being the secondary oil producer because the old oil wells are all dried up to becoming the largest one. And who knows what the next round of because oil, after all, is a source of energy. To the extent that other energy sources are developing, it's really not the demand and supply of oil alone that sets the oil price. It's the demand and supply of energy collectively coming from different places. And to the extent that other technologies become more viable, that's going to put pressure on oil. So I think that that's part of the game as well, is when you look at a commodity, while you can look at the demand and supply of that specific commodity, you have to think about it in the larger context. Ultimately, we use oil because we need to drive our cars. But if we can have electric cars, well, we're going to drive our cars with after all, ultimately, as long as the car gets me from point A to point B, I'm not attached to oil per se. I'm attached to getting from point A to point B. And that demand and supply, therefore, has to be expanded to be about energy and not just oil. And that's what many oil analysts are still struggling with, because 20 or 30 years ago, you could stay focused just on oil demand and oil supply. And oil came out of the Middle East, and you essentially had a sense of who was producing it. So you were looking at how much incentive they had to control prices. You could look at OPEC and demand, and you could pretty much get a reasonable oil. You can't do that anymore.
Yeah. I think the way I was thinking about it was like when you had $150 a barrel oil, it basically forced technological innovation. And one of the major outcomes was the shale boom due to vertical drilling, like a new technology which takes some time to commoditize.
And don't forget, it also created a lot of incentives for green energy to develop, because with $150 oil prices, a lot of energy technologies became viable, whether it's wind or solar or whatever else. At a $50 oil price, many of those technologies have to go back to being subsidized.
Yeah.
So that's what I meant about this ecosystem of energy, all driven by the oil price.
Sure.
So, and you're right. It is a very complex game, because ultimately we do need energy as human beings, because more and more, especially as Asia develops, you're seeing refrigerators in people's homes. 1 billion Indians put refrigerators in. Where's the energy going to come from for those refrigerators? Long term, we know the demand for energy is going up. And if this had been an oil-only world, then it would have been easy. 30 years ago, if somebody had given you just the demand side for energy and said, what's going to happen to oil prices? I mean, you'd be projecting out what, $500 per barrel oil prices right now. Because you're saying, where the hell is Saudi Arabia going to come up with all this oil? If you'd have missed the entire shale oil development, the entire green energy, technology developing. So I think sometimes with energy, what we don't know is what ultimately drives the price. So I'm saying 25 years from now, if we were having this conversation, we'd be looking back at the last 25 years and, oh my God, I never imagined that would happen, but that did happen. So that's part of the reason I don't try to do the macro part in oil companies. I know I'm tempted to go out there and try to forecast oil prices, but I know there's so much I don't know that's going to happen in this market. So what I'm going to do is take a much more humble position of saying, hey, oil price is $62 a barrel. I'm going to value Royal Dutch at 62. I'm going to decide whether I'm going to invest in Royal Dutch or not at that price. And then I'm going to let the energy market decide what happens to oil prices for the next decade. So I understand where you're coming from, but I also think that trying to use the traditional demand supply mechanism to even estimate what the price of oil will be is, I think, going to give you a headache, because there's so much you don't control.
Yeah, it's obviously an interesting pursuit. The great thing is the capital intensity in that kind of space, so that it creates a window of time. So, for example, hypothetically, if you had $150 oil, how quickly would the extractors be able to come in? Like you said, there's certain restrictions, there's limitations to the reserves. Is there going to be new E&P? So I think that there is a lag time. So if one hypothetically could try to capture interesting data sets, there's an opportunity there. I've heard many guys in mining speculation do relatively well. I'm not saying that there's a proven formula, but it is a very interesting mental exercise, at least.
Take a look at the older commodity companies, because you look at ExxonMobil, they've been doing this 100 years. They're actually, if you notice, they're much more restrained about the way they react to oil prices than the young oil companies, right?
Yeah.
I think young oil companies, not only do they dramatically increase capacity when the oil price goes up, not really recognizing how temporary this oil price change can be, they go out and borrow money, because they think good times will never. It's only after the last 4 or 5 years that they've realized you can't do that. But ExxonMobil never borrowed the money, because they know that these cycles they live in cycles. They don't live in the price. And that's, I think, what you will notice with the older mining companies is they manage the cycle. They don't manage for today's price. And
Sure.
what's more difficult is the cycle itself has become less predictable.
Mm. Mm.
And that's the scary thing for these companies is in the old days, you knew that prices, when they went down, would go back up because it was almost, its cycle was there. Now they go down and you say, well, I don't know whether they'll go back up because who knows what technology is going to come and whack us across the face. So that's what's making managing these companies more difficult is the cycle itself has become more unpredictable.
Yeah. Very interesting. Okay, so let's end this off with something that made me feel very uneasy during during your presentation. And I know you obviously talk about it a lot.
Yeah.
You refer to the idea of faith, you know, and I love, I'm a man of faith, but in business, right? Like imagine if you're an asset manager here, right? The asset manager has to run his operation like a business. The question is, how does an asset management, particularly if one was ever so inclined to utilize intrinsic value, for example, as one of their metrics, and if, for example, they were to be dependent on elements such as faith, when I thought about what you said, I did a little bit of deductive reasoning here. I thought to myself, so how does one derive to a beautiful intrinsic value? And I thought, well, there's so many different ways you could go about concluding a particular number. And then if you were to rely on third-party sources, as you indicated, there could be various different conflicts of interest from the sheer transactional standpoint of coming up with a valuation. I almost come to conclude that it would be so difficult to truly come up with an accurate intrinsic value because of human bias, interest.
Don't try to come up with an accurate. You come up with an unbiased.
Yeah, sure. An unbiased. Even that in itself is extremely difficult, I think, as you might acknowledge.
Yeah.
So let's say there was a 1% chance that humans have the ability to come up with an unbiased intrinsic valuation. I really wonder about the scalability of that, particularly if I was setting up a multi-billion-dollar value fund, hypothetically, running it like a business, having to report to investors on a quarterly basis, presenting an NAV. Remember, I'm paying my valuers and my auditors to provide this NAV valuation as well if I want to make a case that there could be some mispricing due to the relationship of price and valuation. So there's so much different conflicts of interest. And you acknowledge that as an independent investor, I feel comfortable with that. Like if you control all the variables, perhaps you have that exceptional ability. How does one in the financial service space become truly unconflicted, unbiased, and be able to scale this amazing ability to identify unbiasedly values of businesses?
You got to be lucky before you get good. In other words, if you start a value fund, you need a couple of years where luck works in your favor, where your bets pay off. You get people's trust, because this is ultimately people have to trust you. There's a reason people invest with Warren Buffett.
Responsibility.
And I think the problem is it's a chicken and the egg problem. How do you develop trust if you don't have a track record, right? So when you first start, even if you're doing everything right, you say, trust me, people are going to very reluctantly put their money with you. They're not going to trust you yet, because what have you delivered? You almost need to be lucky those first couple of years if you're managing other people's money in terms of delivering results. And you've got to be picky in your clients. It's got to go both ways, right? You can't, because the problem with money management in general is you want to manage a lot of money because your fees are often a percentage of the money you manage. So if you're a $100 million fund, you want to become a $1 billion fund. If you're a $1 billion fund, you want to become a $10 billion fund. And as you pointed out, not all things are scalable. So you might have to decide what your scale is. Whatever your philosophy is, to say, hey, given my philosophy, which is to look for small, ignored stocks in emerging markets, I can't run a fund more than $1 billion. And once I get to $1 billion, I'm going to shut the fund down. You got to, remember Warren Buffett's reputation was made in 1968 when
With his private partnership?
When he liquidated his private partnership, and he sent his money back saying, I have two choices. At current prices, and because the stock market had gone up so much, he said, I can bend my philosophy and find things to buy, or I can stay true to my philosophy and tell you that I cannot find things that I can invest your money in, and I'm returning your money. Mm-hmm. He could do that because he ran the partnership. Can you imagine being a Fidelity Magellan mutual fund manager? You'd be put in handcuffs and taken out of the building before you could send that letter out. So you're absolutely right. This is something that a traditional mutual fund family is going to have a very difficult time doing. It requires a personal component. That's why you're more likely to find an individual who's developed a reputation, who stays true to it, and essentially that has developed trust through years of doing the right thing, which might involve returning cash to investors saying, hey, you know what? This is not the market I want to invest in, and I'm giving you money back because I don't think it's fair for me to hold on to the money looking for things.
Sure.
So it's going to be, there are a few people who can develop that reputation. It takes a long time, and there's always a name attached to it. It's not a mutual fund family name. It's an individual's name.
Individual. Yeah.
But I also think you're pointing to two other things as a consequence. One is because value requires faith, most people choose to price. 95% of portfolio managers who claim to be value investors are nothing of the sort. They're traders. They're just very fancy traders. They play the pricing game. They buy at a low price and sell at a high price. They go for momentum. But they cloak themselves in this value cloak because it makes them look more
credible,
profound. Yeah. So first thing I think you're catching on to is when somebody says they're a value investor, it's time for you to start digging, because after about the third or fourth question, you're going to realize very quickly that they're not value investors, that they're pricers with this value cover. The other is you're also seeing why there is this global shift from active to passive money, right? ETFs, index funds, because people don't have, essentially people are starting to see it. 50 years ago, we could have hidden this. The opacity of the money management business was such that you had no choice but to put your money with these money managers and trust them. And they said, have faith in me. Now you can actually see the results. You can compare across. So I think you're starting to see why there's this global shift happening from active money managers to passive money managers. Faith is hard to find and even harder to deliver on.
Particularly in something related to making money and investing, in my opinion. I think that hence the separation between church and states, right? One is something within the world that we're in, and the other is a little bit more metaphysical.
What I'm saying is maybe there should be a Buddhist manifesto on money making. Maybe maybe you need serenity to be a good investor.
I'm gonna have to travel to India and get that revelation, just like the Beatles. Then
I have to travel that far, right? You can go to Myanmar and probably find a monastery there to join for a year or so. I think that as investors, I tell people, when you're an investor, your biggest enemy is you.
Right.
So in a sense, as human beings, we're hardwired to not be good investors. Hardwired by genetics, hardwired by history. We're hardwired to panic, to join into crowds. All those things that people complain about as being irrational are actually human components. So in a sense, what you're looking for is this peace with yourself. Obviously, nobody's ever going to become, I don't want you to become the next Dalai Lama. But you at least need to know yourself before you can become an investor. You need to know what makes you tick. You need to know you're uncomfortable. So it's good that that made you uncomfortable. Hold on to moments like those. When you sense something making you uncomfortable, you're learning something about yourself, because that is something you got to incorporate into your own investment philosophy. Because I don't want you to have faith in my philosophy. I want you to have faith in your own philosophy, and that requires kind of customizing it to meet your specific needs.
Being uncomfortable is a source of growth, and I think that is a great way to end this conversation. Well, thank you very much. Actually, before we end this, because we're having such a fun conversation, I hope you're having a fun time. I love to get something exclusive. I love to get some insight, some tidbit that you've never ever discussed with anyone before that you might have noticed. Give me some cool feature about pricing or valuation or balance sheets that you never discussed about with anyone, just so that I can save this moment and perhaps cherish it.
I am in the habit of kind of vomiting everything I learned, right as I learned to my writing. So, but my most recent post is actually something that it was from 4 days ago. So so most people haven't read it. So might as well read it here. For a long time, we've drawn this cleavage between investors and people who look at charts and do technical analysis. And in a sense, for a long time, we've often treated them with contempt, support lines and resistance lines and 52-week highs and 52-week lows, and saying, who looks at this? It's like an astrologer looking at the stars. Right. Actually, my last post, I said, maybe we should be talking to each other. Maybe there's something in technical analysis that I can learn as a value investor. Because I think the reality is, for whatever reason, that markets attach more value to some numbers than others. So when Apple and Amazon crossed $1 trillion, from a value standpoint, $1 trillion is no different from 999.999 billion, right? It's just $1 more. But that $1 trillion trigger might in fact expose Amazon to an enemy that they've never had before, which is governments are waking up around the world saying, maybe we need to stop Amazon.
Right.
Somehow crossing triggers can affect value. That was my point, is maybe we need to pay more attention to support lines and resistance lines, 52-week highs and lows, because there is something that seems to happen in markets when those numbers get breached. And that can affect you as an investor even if you're a pure value investor. So my point is, let's stop treating some investors as shallow and some as deep, some as good and some as bad. We're all in this for the same reason. We want to make money in investing. And from that perspective, we can always learn from each other, no matter what we think about the other's philosophy.
Right.
And that's, I think, the message I give you with is there's something you can learn from anyone in the market, even somebody you thought doesn't have so much to bring to the market.
So this is your coming out party. This is your technical analysis coming out party.
And resistance lines right now.
I'd love to share one perspective as well, because on that very subject, because my background is actually in information systems. So the way that I got into finance was more from how can we identify quantitative aspects towards price and valuation, to be honest with you, and having that multidisciplinary background. What I've come to observe in many, social sciences and even major sciences, like in psychology, there's many different schools of thought. There's no general universal theory for that. Same thing with physics, for example. You have quantum physics and then you have astrophysics. Nothing that really blends everything together. This was Einstein's pursuit. And I noticed that in finance as well, there seems to be that separation. Basically, people that want to focus on price, and there's people that want to focus maybe on intrinsic value. And I always felt that quantitative analytics is the nice blend of both, because effectively you're just analyzing numbers. The key thing is, what are you analyzing? In the case of technical analysis, they're primarily just analyzing price. Yeah. And in the case of fundamental analysis, maybe you're just doing some kind of say DCF or something like that. Right. But I think that there is a nice confluence that can be put together, and the quantitatives is the one I think that merges both together. It could be some kind of, hypothetically, entertain me for a second, some kind of valuation model in confluence with price as a certain form of feedback. You know what I mean? And I think the only way that could be achieved is through quantitative analytics.
And if you bring in behavioral finance, which is the psychology of pricing, then you got a fortune.
Exactly. Auction market theory, which is not discussed a lot about by the mainstream, I think is if one is strictly interested in price, nothing is as precise as observing basically changes in bid and ask behavior, because one needs to understand the stock market mechanism before one talks about price, in my opinion, as well. So there's so many different things that can be discussed about, but very interesting to hear from you and having this coming out party. This should be my headline of this podcast, right?
Well, I'm glad we did this. Thank you.
Okay, well, thank you very much.